Big news this week is inflation has eased to 3% in June. We'll throw up a chart here. It's the slowest pace in more than 2 years. So the Fed's increases have worked. And I guess the question now is, are we going to have a sustained high interest rate, or is it going to get cut slowly? Chamath and Friedberg, you've been talking to a number of people about this. I think All In Summit 2023 speaker Larry Summers has been pretty vocal about this. What's your take, Friedberg?
Yeah, I think Larry said publicly that he thinks that rates are going to need to be higher for longer than what the market is currently showing. We talked last week with Brad, obviously, about what the market is showing rates to be, and he's assuming some rate cuts will start to happen in December, and that's really what the market is saying is going to happen. And Brad's point was the market knows better than the forecasters. But Larry Summers has publicly shared that he thinks that is actually not correct. And, again, diversity of views is important to understand, that there are structural things that are happening in the world right now, including a decoupling from China, which is inflationary because, China provides cheap goods and cheap manufacturing for a lot of industries, and many of those industries sell to consumers. So ultimately, those prices are going to show up in consumer costs. There's an increase in energy transition expenditure and security globally. And Summers has pointed out that those are not free. They have to be funded. And obviously, taking on more funding means you're going to have to pay higher interest rates for investors to provide that capital to do that funding. So there are more structural, longer term trends that some folks in the Summers camp have been arguing are going to be driving inflation higher and keep rates higher for much longer than what the market is currently showing. And I think it's really worth noting that point of view, particularly given how quickly the market thinks rates are going to start getting cut.
Chamath, you've been talking about the interest rates and that you believe it'll be persistent, so higher for longer. You sticking with higher for longer on the interest rates, I assume?
Yeah, I think the more important thing from that, JCal, is so what do we do about it? And I think the most important point of view that I'm trying to get to is, where do I think the equity market is going to go? And, all roads, at least right now, look like the market is getting set to go materially higher. And the reason isn't whether, terminal rates are at 2% or 3% or 3.5%. I don't think that matters that much. What matters more are the trillions of dollars that are sitting on the sideline or in other defensive assets that need to then pivot around and get put back into growth assets once you know that the worst is behind us. And I think that's what a market always looks for before real sentiment changes. And what's important to note is that by the time most people figure out that the sentiment has changed, it's already actually too late. And so I think right now in the next sort of 12 to 18 months is really when the bottom is put into the market. It's before the Fed starts cutting. It's when rates are still going to be relatively high, but the really astute sharp in this market will get ahead of it, and they will start to buy what they think will be an eventual rally. And then it's going to get supported by the fact that if not enough people are also long, you get caught on the wrong side. You don't necessarily have to be short. You just aren't long enough. And what that does is put pressure on your business model. So if you're a mutual fund or if you're a hedge fund and you've missed most of this rally, which most people have because it's really only been 5 or 6 companies. So I think that Larry is right. I think that I still believe what I've said for a while, which is rates will be higher for longer. But what I didn't believe before was that the market was set to go up. I think we did a great job. I think literally that when I made that comment November of 21 about starting to sell, it was the absolute top of the market.
Yeah, you nailed that one.
Nailed it.
Yeah.
And I think my commentary now is that we're putting in the bottom. And I think the market is set to go materially higher, even if rates are persistently higher for a while.
Just to challenge you on that second point, the bottom really was put in maybe last summer. You're really speaking to the psychology and the dynamics of capital allocation. There are people who were scared maybe and thought the bottom could get much worse, and they didn't want to put money at play. There were some people who were brave enough to put money in play in the last 12 months. I'll give myself a pat on the back. I did J trading starting last summer, and I'm up 25%, something crazy like that, because I picked all the big tech companies. But you're saying now, because
that's a good example, just to pick on that. The reason you did well was mostly because they were oversold. Meaning,
Yeah, that
if
was
you look
my
at those
perception.
tech- If you look at those big tech companies, but that's not a sustainable thing if you're trying to own great companies. The reality is those 7 companies, one of them, NVIDIA, is actually firing on all cylinders. Everybody else just stopped acting like a fucking moron. And that's not a sustainable business strategy, meaning, burning billions and billions of dollars a quarter totally wastefully with all kinds of random free stuff to a bunch of entitled
Side
employees.
projects, side quests.
And then taking that away doesn't ensure long-term success for anybody. All it does is just tourniquets the bleeding. And so you have more material short-term cash flow. And the markets are going to reward it, especially in a moment where the trade-off is against rates, short-term rates that are 5 or 6%. But from here, right, the real long-term value creation is still going to go to the companies that are building true product market fit and product value.
Well said,
and
well said.
are really growing in a material way from adoption and usage, not from cost cutting, because people see through that. And when rates start to get cut, they'll see through it even faster. The only time cost cutting gets rewarded is when short-term rates are this high, because people love short-term cash flow.
Yeah, and it was when the moment I saw Zuckerberg and Airbnb, Uber, other places just start, and obviously Google and Microsoft start making cuts, you're like, okay, people are going to lower their costs. They're doing triage, as you're saying, to make the balance sheet, to make the earnings.
Triage works in the final third of a bear market.
Okay, so...
But triage does not work in a bull market. You don't get rewarded for triage in a bull market.
I totally get it. You have to innovate. You have to build great products. So Saxman, you're looking at the overall market. I think we talked about the average recession or downturn is 6 quarters plus or minus 1 or 2. Historically, we are entering the 7th quarter of the downturn, at least in tech. Started by tech in the first quarter of 2022. Here we are in the 3rd quarter, starting in July of 2023. What's your take on what the next 6 quarters look like? Are we going to be sideways? Or are we going to, as Chamath's saying, hey, there's a lot of people who are trying to pay catch up. They missed this bump, and now they're competing, and they have to, at the end of the year, capital allocators are going to show in their yearly reports what they did this year. And now they're like, hey, we got to put some bets into some high growth companies. Is this the setup for another mania and maybe unhealthy behavior?
So, Jason, I don't think it's going to be a mania, but I do think that the market is ripping today because the market is basically pricing in the idea of a soft landing along with inflation being tamed. So you had a positive CPI report at 3%. You had a hot jobs report a week or 2 ago. And there's an interesting article in the Wall Street Journal today talking about the odds of a soft landing improving. And they have some data for that. I don't particularly agree with the subheadline. They're trying to...
Latest data suggests a lot of past inflation was transitory. That seems...
Yeah, that I think is being too charitable to the Fed, because when they use the word transitory, they were using it as an excuse not to raise interest rates. And we just had the fastest rate tightening cycle ever over the past year. That's the reason why inflation has gone down. It was not transitory until they jacked up interest rates from 0 to 5%. So the Wall Street Journal, I think, is doing a little covering for the Fed there. But nonetheless, I think everybody is pleasantly surprised that A, CPI is now down to 3%, and B, you have not had a significant cooling of the jobs market. So certainly the odds now of a soft landing have gone up. And the thing that's sort of surprising about what Larry Summers is saying is that if you believe that inflation is going to come roaring back, that's certainly a contrarian bet. That's not what the market is saying right now. What the market is predicting right now, and the reason why stocks are rallying, is what the market is thinking is, well, if inflation is down to 3% and we can end the year at 3 or even lower, then the Fed can start cutting next year. And so they're starting to price in rate cuts. But if inflation comes roaring back, you're not going to get rate cuts. And so stock prices are going to go down. I don't see how you can have a scenario of even higher interest rates from here along with higher stock prices. I think you need lower rates to get higher stock prices.